For years, he was the investor most feared by Wall Street executives. A tough guy with a strong, inflexible character and a good head for business. Over time, Carl Icahn has become one of the most important investors in history. Someone who grew up in Queens in a middle-class family who went to a public school, yet has managed to achieve one of the 80 greatest fortunes in the world. To give you an idea, according to Forbes' net worth, his wealth exceeded the incredible figure of $14 billion at the time of making this video. You don't have to look any further than his own Twitter account to see how he describes himself.
Some people get rich studying artificial intelligence. Me, I make money studying natural stupidity.
Don't tell me that it's not a really clear statement of intent. But you know what? It's not just a matter of money with Icahn, but above all, a matter of philosophy and style. His tough guy fame may have waned a bit these days, but for a long time, Icahn was known for his aggressive way of operating in the markets. We're talking about an activist investor who has never had any qualms, even dismantling entire companies, if, for him, that was the best way to manage capital and make a profit. This was a strategy, a way of working that, as you can imagine, has never made him a lot of friends, but one that has made him a source of inspiration for the media and Hollywood directors. For example, Time magazine defined him as the real Wolf of Wall Street, and Michael Douglas and Richard Gere have acknowledged that the roles of Gordon Gekko in the film Wall Street and Edward Lewis in Pretty Woman were heavily influenced by this real-life investor. And look, perhaps the best example of how good Icahn was is by looking at his handling of Trans World Airlines. For decades, one of the most important airlines in the United States. In 1985, Icahn took control of this airline, taking on a huge debt in the process. Over the next few years, he methodically sold assets of this company to get the funds he needed to return the money that he had borrowed, an operation very similar to the one that Gordon Gekko orchestrated in the 1987 film Wall Street. Friends, he may not be so well known, but for the last 20 years, Carl Icahn has not only managed to beat the market repeatedly, but his profitability has been far superior than even Warren Buffett himself. But who is Carl Icahn really? How did he get into the world of markets? How did he make his fortune? What investment style does this already legendary investor use? With this new video in the series that we are producing in conjunction with Value School, we'll tell you. Listen up.
The road to stardom.
Despite being born into a family without any great luxuries, Icahn was able to attend and graduate from the prestigious Princeton University.
I had no food or place to sleep, but in the summer I worked as a maintenance guy at some beach huts on Long Island. I bought large amounts of ice to sell to the customers on hot days, and at night I played poker with the owners. I bought 3 books, studied the games, and cleaned them out. Carl Icahn.
Well, it doesn't seem like a bad start, does it? Well, yet it wasn't until after graduating from Princeton, spending 2 years in medical school and enlisting in the military, that Icahn finally began his career on Wall Street. But let's move on, because the story, the real story, begins in 1975. That year, Icahn was already self-employed with his right-hand man, Alfred Kingsley. At the time, both focused on their efforts on conducting arbitration operations, i.e. simultaneously buying and selling an asset that is traded in 2 or more markets at different prices. Well, that's the theory at least. As you can imagine, the practice is usually a little more complex.
Icahn and his partner specialized in what is known as convertible arbitration, i.e. opening short or long positions in shares and convertible securities of the same companies simultaneously. The idea was to take advantage of the small differences that, for different reasons, could be recorded in the market. However, they soon expanded their range to closed investment funds. In these cases, Icahn and his partner invested in the funds by buying their stakes at a discount, whilst financing those transactions by short-selling a stock portfolio equivalent to the funds themselves. The goal was to take advantage of the discount the funds had.
And right here is when the two partners ask themselves a question. How could they make the funds close their value gap relative to the stocks they had in their portfolios? Well, it's at this very moment that Icahn and Kingsley started behaving like activist investors. Once they established their position, they began to pressure the fund managers to liquidate them, i.e. sell all the shares and distribute the money to the fund's participants. This way, Icahn and his partner could get remarkable profits in a very short time. This strategy worked, but the number of funds with which they could carry out these operations were limited, and that led them to a new thought.
If we can be activists in a closed and undervalued investment fund, why can't we be activists in a corporation with undervalued assets? Alfred Kingsley.
That's the new strategy they put into place in 1975, and their timing was also ideal. You see, after a decade of stagflation, a crisis in the oil market, and a languishing economy, 1974 was the worst year in North American markets since the Great Depression. Since the peak of 1973, the US stock exchange has lost 45% of its value. This caused many shares to be clearly undervalued, with trading levels well below the asset value itself.
In our view, the elements of today's economic environment have been uniquely combined to create great benefit opportunities with relatively low risk. The real or liquidation value of many US companies has increased markedly in recent years. However, and this is what is interesting, it has not been fully reflected in the market value of the shares. Carl Icahn in an investor's memo.
Now, how did Icahn choose his investments? What was the method that pushed him to the top of the investment world? Well, let's see.
The corporate assault.
Our protagonist in this video made his fortune as something like a corporate raider. He would buy a major stake in a company and then try to force management to make certain decisions that would cause the share price to increase. To achieve this, he used all kinds of strategies: media pressure, active searches for potential buyers, disinvestment plans, power struggles, etc. Take a look at this. From our perspective, we believe the great profits can be made by taking long positions in undervalued actions and then trying to control the fates of companies with the following actions. A. Trying to convince management to liquidate or sell the company to a white knight. B. Provoking a power struggle. C. Making a purchase offer. D. Reselling our position to the company. This is what writer Mark Stevens called the Icahn Manifesto. As you can see, in the eyes of this investor, one of the biggest difficulties facing shareholders is the one known as the agency problem, a well-known problem in financial theory. For those of you who don't know what it means, it's that the managers of the companies usually have different objectives than the shareholders, in that the managers do not know much about maximizing the value for the latter. So, leading activism campaigns, if you're strong enough, was something that could generate significant returns. Of course, before we get carried away in this excitement of boardroom power plays, keep in mind that these kind of campaigns also had a much more controversial side.
Many of these activism operations ended with a practice that is now banned. It was known as greenmail or business blackmail, a financial practice consisting of the following. After unleashing a power struggle and a media campaign for control of the company, Icahn negotiated the sale of its shares to the company itself in exchange for a generous premium.
In this way, the executives managed to save their heads and got the annoying Icahn out of their way. Of course, those who paid the price were the rest of the shareholders. We are talking about a practice that Warren Buffett himself came to describe as hateful and disgusting. Of course, to be fair, the fact that Icahn was able to close numerous such agreements says very little of the integrity of the managers themselves. Of course, not all operations ended this way. One of the best known examples, and at the same time, one of the first operations that made a name for this investor, was his handling of the Tappan Stove Company, a manufacturer of ovens and stoves that was going for a rough patch. Icahn gradually bought a larger and larger stake, and when he had enough weight, he got a seat on the board of directors. And from there, he promoted the sale of non-strategic assets and tried, by all means possible, to find a buyer for the company. So, can you guess how it all ended? Well, look, Icahn began investing in 1977, when the shares were traded at around $8. Just 2 years later, and thanks in large parts to Icahn's maneuvers, Belgian manufacturer Electrolux ended up paying $18 for each share. That is, he more than doubled his investment in just over 2 years. And don't think that this was an isolated case. In the table below, you can see some of his most lucrative operations. At the height of his career in the 1980s, Icahn controlled billions in capital and caused real dread, even among executives of the large corporations in the American Stock Exchange. His campaigns have continued up to this day. For example, in 2019, he launched a public campaign against the board of directors of Occidental Petroleum for an agreement that they had reached with Warren Buffett. Another well-known recent example was his role in pressuring Apple to launch what may have been the largest share buyback program in history. It made no sense to this investor that the Cupertino-based company should accumulate tens and tens of billions of dollars in cash. Now at this point, one question that comes up is, but how does he decide in which companies to invest? Well, although he's not exactly known for being a value investor, the truth is that if we study everything on a case-by-case basis, Icahn has almost always followed Benjamin Graham's thesis. The vast majority of his operations have centered on companies that, for various reasons, seems to be trading at a huge discount with respect to their intrinsic value. His role was then to drive enough corporate changes for that hidden value to emerge, even if it meant liquidating the company itself. An idea that Graham, the father of value investing himself, defended on numerous occasions. Anyway, this story of Carl Icahn, one of the great investors of all time, an atypical investor who, of course, has also made huge mistakes, some as well known as Blockbuster, Yahoo, or more recently, Hertz, a company that we covered not long ago in this video, and that has cost this investor more than $1.5 billion. So I really hope you enjoyed this video. Please hit like if you did, and don't forget to subscribe for brand new videos. Also, this channel is possible because of Patreon and our patrons on that platform. Please consider joining them and supporting our mission of providing independent political coverage. And as always, I'll be seeing you in the next video.